How does the Federal Reserve arrive at a 2% inflation target? Join Richard Ebeling and me in this week's Libertarian Angle as we examine that question. Hi, I'm Jacob Hornberger, president of the Future of Freedom Foundation, and welcome to this week's Libertarian Angle, the show that brings you all the principled, uncompromising case for the libertarian philosophy. We've been doing that, not this particular show, but we've been making that case for principled libertarianism for 34 years here at FFF. Thank you for your great support. And I'm joined by my co-host, Richard Ebeling, professor of economics at the Citadel, who was vice president of academic affairs when we first started FFF. He was at Hillsdale College as the Ludwig von Mises Professor of Economics, went on to become president of FEE, and now at the Citadel. Richard, good to see you again.
It's good to see you and to be with our viewers and listeners.
All right, Richard, let's talk about inflation policy, specifically the Federal Reserve. I mean, you've done this fantastic book for us, Monetary Central Planning in the State. You understand Austrian economics as well as, if not better than everybody around. And so we've got this Federal Reserve policy that is everybody's talking about. The Fed reduced interest rates recently by 0.5 percentage point, and this was after many years of having essentially 0% interest rates, and then all of a sudden they got hit with this huge increase in the price level, so they skyrocketed interest rates, and now they're supposedly on their way down. Now you've got some unemployment figures that indicate that they might delay further increases. But the thing that, I mean, we can focus on the overall activity of the Fed, their central planning activities, and I think that's important. But what I'd like to specifically focus on is the 2% target. They are targeting a 2% inflation rate. Now, I think before we do that, I think it's important to define our terms. You know, what do we mean by inflation? Because the traditional meaning of inflation, the Austrian economics school, says that inflation is an expansion of the money supply. In other words, they're inflating or expanding the money supply. So how much are they inflating by? That's the inflation rate as genuinely understood in economics. But over the years, we know that that term has been distorted and warped and perverted by statist economists, by the mainstream press, by public officials. So a lot of people now, when they refer to the inflation rate, they're referring to the price level. What's inflation? Well, the prices have gone up 2%. They're referring, I think, most of the time to the consumer price index, but we can get into that. So I think it's important that as we focus in on this issue of this 2% target, what the Fed is talking about. Are they talking about a 2% inflation of the money supply, expansion of the money supply, or are they talking about a 2% increase in the level of prices? And you can correct me if I'm wrong when I turn it over to you, but it seems to me that they're talking about the price level, that they're looking at prices, overall prices, and they're saying, okay, we don't want prices to increase more than 2%. That's our target, where prices across the board are increasing 2%, which of course means that they're expanding the money supply. Because if we talk in terms of what causes this price level to increase, an overall price level, we're talking about debasement of the currency. The more they print the money, so to speak, that devalues the value of everybody else's money, and the only way that devaluation is going to be reflected is in increase in prices of what money buys, of the things that money buys. So if the government's inflating the money supply or expanding the money supply, you're going to see an overall increase in the price level, whether it's 2% or 10%, or like in places like Venezuela, 100, 200%. So the real question is, where do they get this 2%? It seems to me it's entirely arbitrary, and that if they're going to say we want a 2% increase in the price level, they're essentially saying we want a increase in the money supply annually to reach that 2%. Well, we can delve into the harmful aspects of inflation or increase in the money supply. The Austrian school has been very good at that. Um, and it seems to me that those harmful consequences are going to manifest themselves, whether the money is being expanded by 2% or 10% or 20%. What do you think?
Okay, let's, as you're saying, define our terms a little bit. First of all, even if we were defining inflation as a 2% rise in the general level of prices, usually reflected or represented in something such as the Consumer Price Index. And for those who may not be too familiar, the Consumer Price Index is constructed and tracked by the Bureau of Labor Statistics. They issue a monthly report about what has happened to the CPI. Now, the CPI is derived by doing a huge survey of literally thousands and thousands of households irregularly, uh, and determining what is the average American household for the country as a whole, an urban family in a metropolitan area, usually presuming a blue collar job, with 2 adults and 2.5 children. You used to say a man and a woman, but that has become politically incorrect. So I'm just saying 2 adults in the household. And 2.5 children, well, some families have 1 kid, some families have 4 kids, some families have no kids. So if you average out the average size of the family, that's why it's 2.5 kids. And so having surveyed these thousands of households, both what is in this representative basket and the relative amounts, how many quarts of milk, how many loaves of bread, how many times a week eating out, et cetera, what's your mortgage or your rent, what's your car payment, all of these different categories of different types of goods. They then track this basket of representative goods and relative amounts through time. So a year from now, did the basket that cost $100 today to purchase, what did it cost a year in the future? So we could imagine that the basket had increased in dollar cost from $100 to $102. So they would then say that over the past 12 months, in general, the cost of living and the general level of prices have risen by 2%, right? $102 over $100. And that's basically how they're measuring these things. As a result, what's noticeable in this, and you were alluding to this, Jacob, is that it tells us nothing about why those prices have gone up in this fashion. Could it have been a catastrophic war or some great natural disaster that resulted in a dramatic decrease in just the absolute availability of the goods and services purchasable and available on the market? That certainly would affect both individual prices and just the general availability of goods. Think of a small country that suddenly has a massive earthquake or a volcano, and the economy is just devastated. But minus those types of things, primarily the factors behind this are changes in the money supply. And if the money supply does not increase in some way, then all other things held given, prices in general will tend not to rise. Let me give an example of what I have in mind. Again, imagine an individual has $100 and he spends $50 on product X and he spends $25 each on product Y and Z. Suppose that he wants to increase his spending on product Z by $5. That means that given his income of $100, he has to reduce either his purchases on X or Y by $5 or some combination of a reduction so he can shift $5 of his given income to buying $5 more of the Z commodity that he's interested in increasing his purchases of. Now, one price rises, one or more prices have to decrease as you reallocate your given sum of money. There is no way that the dollar cost of and demand of X and Y can stay the same, and at the same time increase the amount of demand and what you have the ability to pay for more of Z, unless there's an increase in your dollar income. You would have to receive then $105. Then you can leave your purchases of X and Y the same and have extra dollars to buy more of Z. But unless that happens, there cannot be a general rise in prices, which means that, because then if you average it out, the price of X, the price of Y, and now the higher price of Z, the average level of prices would be higher. Now, that can only happen if there's an increase in the quantity of money. That very simple, and I'll even admit simplistic example, is a core fundamental truth. Now, of course, some economists would say, but wait a minute, there doesn't have to be an increase in the supply of money. People in the past may have purchased things less than the income they had earned, and they had built up a cash reserve, a cash balance. Could they not reduce their cash balance to buy more of the Z? Absolutely. But at some point, your cash balances either reach a level below which you don't want to go any further, or you've used up your extra cash balances, and now you're just stick whatever your $100 money income enables you to buy. So that's a very limited effect. If there's to be a general rise in prices that is sustained and continuous, it has to come from, broadly speaking, other things I'll give in ceteris paribus, as the economists like to say, from an increase in the money supply. There's nothing else that can do this from that long run perspective. Now, a couple of other things that I should say here. 2% sounds very little. You know, you go shopping this year and it costs $102 to buy the basket instead of $100 last year. Yeah, $2 more, but you know, in the stream of things, you say, okay, an extra $2. What's the extra 5 cents for the Starbucks coffee and the extra 10 cents for a loaf of bread? And so, but what is missed here, Jacob, is that if prices rise by 2%, so it's $102 instead of 100, and then 2% on the $102, and then 2% on that higher cost and price level, and 2% on the next, and the next, and the next, in around 20 years or less, the general level of prices will have gone up by almost 50%. That's a dramatic fall in the purchasing power of what your dollar will buy, just from a mere 2% price inflation. Now, the other thing that you raised, which is significant and important thinking about as well, is why 2%? Why not 1.5? Why not 3? Why not 0? And this all has to do with the managing of macroeconomic policy, Jacob. It all has to do with the managing of macroeconomic policy. The presumption is that an economy will be more adaptable and flexible if prices are generally rising. It gives it like a little margin of a boost. Prices are rising relative to the cost, more money, people have more to spend, and acts as a profit stimulus to greater output. And so that little 2% is sort of like the stimulus for the economy to keep growing. Now, that was answered a long time ago by a well-known Swedish economist named Knut Wicksell, who himself was influential on later Austrian economists. And he uses the analogy in his book on prices and interest from the beginning of the 20th century, that imagine that a person is afraid of being late for his commuter train in the morning. So he sets his wristwatch or his clock 10 minutes ahead so that he won't miss the train. But you see, the thing is, he knows he has set the clock 10 minutes ahead. And then in the morning when he's getting ready, he doesn't panic because he says, oh, I still have 10 minutes because I know I set it ahead. You see what I'm saying? Now, if everybody knows that the central bank, the Federal Reserve, is going to be increasing the money supply on average and in general by 2% each year, and that's supposed to act as sort of like this moderate little stimulus margin, people will immediately adjust to that. They'll know that cost prices will be generally rising, either in lockstep or shortly after that in some ragged way. They'll build this into their contracts, their pricing expectations, and the stimulus that the 2% is expected to give will be dissipated by price inflation expectations. So it's not even realistic in itself to expect that it can serve as this. But the other thing that the Fed and central banks in general want this chosen 2% price inflation for is that what if the economy goes into a recession? Now, we're not going to ask why the economy would go into recession, because they're just concerned with the reacting to whatever is causing an economy to go into a recession. they will then say, oh, the economy is gone into recession. Prices are because of decreasing demand, falling off of production as workers are let off because of the decrease in general demand. Price will be falling, and they'll only be 1.5% or 1%. See, that's a margin here above zero that they can still try to stimulate the economy with by just pumping it back up to 2%, to 2.5%, or 3%. So this is sort of a policy tool. Now, again, one other point, if I can have a moment here. You had alluded to the Austrian analysis of inflation. And what's important is that prices in general, prices in the economy do not rise in general at the same time or to the same degree. And it has to do with what Austrian economists and others call the non-neutrality of money. For example, if you open the Wall Street Journal on a Friday and go to their credit markets column, some of the information there will be, well, what has the Federal Reserve announced the day before on Thursday about what had happened to the money supply during the previous week? And it wouldn't be unusual, Jacob, for the announcement to say, well, last week the money supply increased by $50 billion. Well, they're saying there's $50 billion more dollars circulating in the economy made available and provided by the Federal Reserve. Now, you open your wallet, I open my bank account, and I notice, where's my percentage of this? Out of 330 odd million people in the United States, where's my fraction of the $50 billion? I've had no increase in it, but they say there's $50 billion more in the economy. Well, this is due to the fact that the money has to enter the economy somewhere. It doesn't, like helicopter money, proportionally dropped into people's pockets or accounts. In our institutional way, the money is injected first through the banking system in the form of extra lending reserves made available to the commercial banks that are part of the Federal Reserve System. This stimulates lowering the cost of borrowing, the rate of interest in the short run. It results in people finding that a lower rate of interest, it may be profitable to undertake a business loan, an investment project, maybe a house purchase. And the new money enters the economy by those borrowers taking up additional loans with the newly created money. And from there, they spend it. It passes to another group of hands. They have greater money incomes to spend. They spend it. Then the other group spends it. And all prices are rising, but in a certain sequential pattern based upon where it's injected and from what particular group of hands it passes first, and then second, third, and so on. The analogy I sometimes use is, imagine that there's a pond of water and you drop a pebble into the center of the pond. And from that epicenter, there will emerge ripples. The surface of the water will not rise or be affected immediately. There'll be waves or ripples from the point at which the pebble has been dropped into the pond. And the surface there in waves influence. Well, that's what happens with increase in the money supply. Waves of extra money spending, next group of spending, next group of hands, next group of spending, next group of hands, until finally, given the greater amount of money in the economy due to this monetary expansion, all prices will, at the end of the day, tend to be higher, but they will have increased at different times by different amounts, and the patterns of the prices at the end of the process will be different from where they began. And therefore, that affects relative prices, relative incomes, relative profitabilities, the influence of how resources are used, and basically all the distortive and imbalancing effect that monetary expansion in general has the potential to create. But this is all hidden from view due to the fact that they're just talking these general aggregate terms, prices in general, the money supply in general, spending in general, 2% in general. And this is all a manipulative policy tool used by central banks to try to affect the economy in ways they think, and the politicians behind them think, is necessary to keep the economy on what they consider a growing even keel.
Yeah, well, you've raised a lot of good points. Yeah, let me add to that in terms of, it seems to me, Richard, that they're just guessing. This is the mind of the central planner. This is what Hayek called the fatal conceit, that the central planner can plan something as complex as a monetary system in which 333 million people are participating. And you just get the sense that the Fed is just sort of like groping in the dark, feeling their way, guessing and saying, well, we think this is all that's going to be necessary. We're not sure. We think there's going to be a soft landing from what we've done in the past, but it's all just guesswork. And if they miss, well, we'll have to adjust now that we missed the target and so forth. The other thing is that, as we've discussed in the past, people make plans in the investment world, the business world, based on the price system. The price system is a very intricate mechanism in a free market. And when you've got the government tampering with that intricate system, people are going to be making decisions based on what's going on. They're false signals. If the Fed's lowering interest rates, creating a sense of an artificial prosperity, people say, "Oh my gosh, I can go out and afford a home now. Man, look how low interest rates are." Or, "Oh, I can expand my business. Boy, customers are coming in with all this new money. Man, I'm gonna go out and borrow a big sum of money. I'm gonna expand my warehouse here. I'm gonna buy more inventory." And then when it starts to shake out, that's where the recession or the depression occurs, when people realize there wasn't really that financial capital base to sustain all this activity. So even if it's at 2%, which is used so astutely point out is increasing sort of semi-exponentially every year because it's building on the previous year's increase, that's still going to distort people's decision making. You're still going to have that factor. And then the third thing, in the 19th century, we had the gold standard, which reflected that the framers and our American ancestors, when the nation got established, did not want a central bank. The Federal Reserve doesn't come into existence till 1913 as part of this wave that was starting to develop in favor of socialism and statism and so forth that manifests itself greatly in the 1930s. But for more than 100 years, there was no paper money. You had instruments of indebtedness circulating as near money, bills, notes, but everybody understood that those bills and notes were instruments of indebtedness promising to pay real money, which was the gold coins and the silver coins. Those were that was the real money, the gold coins and silver coins. So during that period of time, we had the soundest monetary system in history. I mean, I think there's no doubt that this was a major contributing factor to the tremendous increase in prosperity and the standard of living from my favorite period in time in history is 1890 to 1910. You just had sound money there. The government was minting the coins, but at least most of the coins, but they were solid coins. There's never any evidence of fraud, of clipping the coin and trying to cheat people with less gold than what was represented to be. And during that period of time, prices were going down over a long period of time because you had increased productivity, you had a stable monetary supply, more or less. And so what happens then when the value of money is going down, as we've talked about, you have this overall level of prices rising in society. But when your money is staying solid and you're increasing the productivity, the overall supply of goods and services, that money is getting more valuable, which is going to be reflected in the lowering of prices. And yet people later on in the 1930s said, "Oh, that's terrible. That's terrible that prices are falling." Why would it be terrible, Richard? It seems to me it's a good thing to see that your money is buying more than it did the year before.
Yes, I should just add a few things to this historical example. If you use some kind of an index comparing 1815, the year that Napoleonic Wars ended and there was peace again in Europe, including in Great Britain, and if you compare the same type of rough and ready price index in 1914, in Great Britain, the price level had remained fairly constant. In other words, there was no disruption. But within that 100 years, and this applies also to the US, there were these fluctuations in prices in general. The most dramatic one was the fact that in the 1840s, there were gold discoveries in California and in Australia almost simultaneously. all of which gently did push prices in general up around the world. But following this type of non-neutrality of money Austrian analysis, there was a famous British economist named John Eliot Cairns in the second half of the 19th century, one of the last of the great classical economists. And following the gold discoveries in Australia, he wrote a series of articles analyzing it. And he showed the non-neutral way the gold discoveries from Australia were affecting prices around the world. First, the prospectors came from the outback, as they call the inland parts of Australia, to the towns with their extra gold dust, gold nuggets. They would bring them to a mint to be minted into coins, and they would increase their demand, their gold demand for the goods at these coastal ports. But Australia is an agricultural country, just some very light manufacturing. Everything has to be imported in terms of actual manufactured goods. So the gold gets exported by these businesses that they've gotten by selling goods out of their inventories to the gold prospectors to Britain and other parts of Europe to import more manufacturing goods to meet the demands of the gold prospectors and others who are getting the gold. And so now the higher prices in Australia are exported to higher gold prices in England and some other European countries. Well, the Europe and other parts of Europe and manufacturing need resources, raw materials, to try to expand their output. So now they have to demand more resources and raw materials from other parts of the world, other parts of in Eastern Europe, from Africa, from Central America, South America, and the gold is then exported to import more of this to Europe. So what Cairns was able to show is that like these ripples from Australia to Europe to other parts of the world, until finally, even though in a rough and ragged way, prices in general ended up being higher globally due to these gold discoveries. But what you're also alluding to is that, particularly in the United States, in the period after our American Civil War, we experienced the American Industrial Revolution. Before 1860, we were an agricultural and light manufacturing economy. We exported food and some crafts and imported all of our manufactured goods, as manufactured consumer goods were known at that time, or machinery to expand production. But after the Civil War was our Industrial Revolution. And we did so through domestic savings, but actually borrowing a lot of European capital, especially from Great Britain. And that fed expansion of industry, technological innovations, mass production, which resulted in us not only paying back the money we had borrowed by the end of the 19th century, in the early years of the 20th, but we actually became a creditor nation. Now, in general, we were lending money to other countries as opposed to we were a creditor country instead of a debtor country. But what is interesting in this is that between 1865 and approximately 1900, we experienced a significant price deflation. In fact, prices fell by about 30 to 35% between 1865 and 1900. But it was not years of a recession or a depression, the usual way deflation is imaged in many people's minds. It was what economists sometimes call the good deflation. The capital investments, the technological innovations, the cost efficiencies introduced enabled more goods and better goods to be manufactured at lower costs of production. And at lower costs of production, the manufacturers can afford to sell the goods for lower selling prices. And if they've correctly anticipated what consumers want and degree of demand for it, you still make a profit. And that's what's happened for that 35-year period from 1865 to 1900. Massive industrialization, rising standards of living, but all occurring through falling prices, so that each dollar that a person had as their earnings could now buy more. To use that consumer basket analogy, suppose the basket had cost $100. And now a year later, it costs not $100, but $95. Well, you buy the same quantities and types of goods as you did a year earlier, but for $95 instead of $100. And that now leaves you $5 in your pocket left over to buy other goods that you previously had not been able to afford. Rising standards of living through falling prices given money incomes. But the one thing to point out is that all of this manufacturing and industrialization and mechanization in agriculture as well, whether it was feeding a huge increase in farming output, represented an increased demand for labor. So that both in manufacturing and in agriculture, money wages rose. And as a consequence, by 1900, looking over that 35-year period, you not only had a higher standard of living because prices were lower given a money income, but money wages were higher, so that you had more money in your pocket and you were paying lower prices for everything. So in general, look at given those two factors, rising money incomes and falling prices, real standards of living increased by about 75% between 1865 and 1900. Now, that could be the case today. If the Federal Reserve was not printing money, if we had a sound monetary system, if the market was allowed to dictate and determine what got produced, how it got produced, its availabilities to consumers based upon the actual market forces of supply and demand, we could have all these similar better qualities of life, including a lower cost of living through cost efficiencies that resulted in prices gently falling, guided by market forces, rather than gently rising, manipulated by central bank forces.
Well, I think that's the big point, is that when you had this gold coin, silver coin standard as the official money instead of paper money, it's the monetary system is independent of the government. I mean, this is what the framers wanted. They wanted a monetary system that was independent of the government. Now, clearly this wasn't 100% independent because the government was coining the coins, but the government was honest. I mean, these were solid gold coins. They contained the amount of gold that was represented to be in them. And the government couldn't print gold. They can only print money. And so that's why the Constitution called for the power to coin money. You don't coin money out of paper, you coin money out of precious metals. And so if we take the Fed out of this equation, and we take the government entirely out of this equation, which is really Hayek's notion of the denationalization of money, instead of the government establishing an official money like gold coins and silver coins, just let the free market make this determination. Now we're outside of the central planning realm. There's no more Federal Reserve. There's no more all this anxiety of what the Fed's going to do tomorrow and what are they going to do the next day and the next year. And you could save tons of print in the Wall Street Journal for all the articles dealing with the Federal Reserve. It would be totally independent. And that's what we call for as libertarians, just a separation of money and the state. Get the government out of the monetarist field. The free market produces the best of everything. Why not a free market monetary system?
And if that was established, we'd be certainly a lot closer to having a free society.
All right. On that note, we'll wrap things up. Richard, as always, greatly enjoyed the conversation. Thank you all for tuning in. Thanks for your great support of our work. And Richard, I look forward to talking to you next week.
Until next time.